Let's get right into the Bitcoin charts because what's happening right now isn't just another daily wiggle. We're seeing a pattern so specific, so rare, it's only shown up once before in Bitcoin's recent history. The last time this exact set of events unfolded, Bitcoin didn't just climb, it exploded. We're talking a 60% surge in just a few weeks that caught almost everyone off guard and kicked off a massive rally. And as of this week, that same rare pattern is flashing again. The setup looks uncannily familiar, which leads every trader and investor to ask one simple question. Is history about to repeat itself, or is this time different? In this breakdown, we're going to dissect this pattern piece by piece. We'll look at what happened back then, analyze the evidence we see today, and lay out the exact price levels that will either prove this historic signal right or prove it wrong. This isn't just another price guess, it's a look at the data behind a potential monster of a move, and it starts now. The last time this signal flashed, Bitcoin ripped 60% higher. Now, it's back. This is a specific, verifiable pattern on the Bitcoin chart with a clear historical track record. We're going to break down whether history is about to repeat itself and what key levels you absolutely need to be watching. The structure we're seeing has been forming for weeks, ever since that huge market shakeout. If it plays out like it did before, the next 2 months could be some of the most volatile and maybe profitable of this entire cycle. The stakes are huge. A repeat performance could send Bitcoin screaming back toward its all-time highs. But if the pattern fails, it could signal a much deeper correction is on the way. We'll look at the charts, check the on-chain data, and break down the big picture to give you a full understanding of what's at play. So, is another 60% surge on the horizon? Let's get into the data. All right, let's jump straight to the charts where this story is unfolding. To really get what this pattern means, we need to understand the market's current mood. Today is October 21st, 2025. It's been a wild year for Bitcoin. We saw the big rally after the fourth halving back in April 2024. That momentum, supercharged by the wildly successful spot Bitcoin ETFs approved in January 2024, pushed Bitcoin to levels that seemed impossible just a year ago. We didn't just break the old 2021 highs, we smashed right through them, blew past the $100,000 psychological barrier, and topped out with an intraday high over $126,000 in early October. But in crypto, what goes straight up must come down, at least for a bit. That new all-time high was followed by one of the fastest, most brutal liquidations we've ever seen. On October 10th, a flash crash rocked the market, sending Bitcoin tumbling from over $126,000 down to a low of around $104,000. It was a liquidation cascade, wiping out an estimated $19 billion in leverage across the market. Sentiment flipped from extreme greed to extreme fear in the blink of an eye. Now, in the 2 weeks since that crash, the market has been trying to find its feet. And this is where our pattern starts to take shape. Looking at the daily chart, we can see a period of tight consolidation. The price is stuck in a range, bouncing between the post-crash low of about $105,000 and a ceiling that's formed near $112,000. This isn't just random noise. The market is building structure. It's a classic coiling pattern after a big capitulation, where volatility dries up and both buyers and sellers dig in for a fight. But a simple trading range isn't the whole signal. It's just the first of three key parts. The second part is what's happening with the moving averages. Specifically, we're watching the 50-day and the 100-day simple moving averages, SMA. During the run-up to $126,000, the 50-day was cruising above the 100-day, a clear sign of a strong uptrend. The flash crash, however, plunged the price below both of them. Now, as the price chops sideways, these two moving averages are converging. The 50-day is flattening and is on a collision course with the 100-day. They haven't crossed yet, but they're getting closer every day. This squeeze is creating huge tension on the chart. Many traders see a death cross as a bearish signal, but what happens after the cross is what really matters. This brings us to our third and most important piece, an on-chain metric called the MVRV ratio. MVRV stands for market value to realized value. Simply put, it compares Bitcoin's current price to what everyone paid for their coins on average. It tells us if the average holder is in profit or at a loss. During the peak near $126,000, the MVRV was high, flashing red, and signaling a market top. The crash naturally sent the MVRV plunging. Now, we're watching how it behaves during this consolidation. After hitting a bottom right after the crash, the MVRV has started to slowly grind back up. It's showing signs of finding a floor at a level that has historically been a launchpad for new uptrends. So, to recap today's situation, we have three things happening at once. A multi-week consolidation. Bitcoin is coiling tightly between roughly $105,000 and $112,000 after a massive liquidation event. A moving average convergence. The 50-day and 100-day moving averages are squeezing together, pointing to a big decision coming soon for the trend. An on-chain floor signal. The MVRV ratio has reset and is showing signs of bottoming out at a historically important level. Individually, each of these is interesting, but when you get all three in this exact sequence, especially after a halving, it creates a powerful and rare signal, a signal we've seen before. And to understand why that's a big deal, we need to rewind the clock to late 2020. To really feel the weight of what could be happening, let's go back in time. The year is 2020. Bitcoin had its third halving in May, an event that cut the supply of new coins. But the explosive rally everyone expected didn't happen. In fact, for months after the halving, Bitcoin's price was just boring. From May until late October 2020, Bitcoin was stuck in a range mostly trapped below the tough $12,000 resistance level. The market was full of doubt. The COVID-19 pandemic was in full swing, and the global economy was shaky. People were asking if the halving was just priced in or if the bull run was a fantasy. The mood was skeptical. People were getting tired of the sideways chop. Then, in late October and early November 2020, things started to shift. This is where we see the historical parallel. Let's look at the conditions back then, which mirror the three things we see today. First, the consolidation range. After failing to break $12,000, Bitcoin pulled back and went sideways for months. This was a long period of accumulation where smart money was buying from frustrated sellers. This long, drawn-out chop is structurally similar to the consolidation we're in today, just on a shorter time frame. Both are periods where energy is built up after a major market event, the 2020 halving and our 2025 flash crash. Second, the moving averages. As Bitcoin went sideways in the fall of 2020, its 50-day and 100-day moving averages got tangled up, moving almost horizontally. Then, in early November, the price started to break out. As it did, the 50-day SMA, which was about to cross below the 100-day, instead hooked up sharply and accelerated away. This was a re-acceleration of the moving averages after a long squeeze. It was the chart's way of screaming that the indecision was over and the bulls were back in charge. This is the exact behavior we're watching for in the coming weeks. Third, the MVRV ratio. During that long 2020 consolidation, the MVRV ratio had cooled off. It drifted down, showing that holder profitability was dropping, but it found a floor. It hit a level that showed the market was no longer overheated, but hadn't flipped into a bear market either. It was reset and ready to go. As Bitcoin began its breakout in November 2020, the MVRV started climbing aggressively from that floor, confirming the rally was real. So let's put it all together. In mid-November 2020, all three pieces locked into place. Bitcoin broke out of its range, clearing $16,000. The 50-day SMA shot up away from the 100-day, and the MVRV started climbing. What happened next was unforgettable. From around $16,000 in mid-November, Bitcoin began a relentless climb. By the end of December, it had smashed its old 2017 all-time high of $20,000 and was trading around $28,000. In about 6 weeks, Bitcoin surged over 75%. That initial move, the direct result of the pattern breaking, was a 60% blast that took the price from $16,000 to over $25,000. This was the ignition for the entire 2021 bull run. That 60% surge was the starting gun. The skepticism vanished, replaced by euphoria. That whole run started with this exact three-part pattern: a post-event consolidation, a moving average reacceleration, and an MVRV floor bounce. This is why today is so important. We're seeing the echo of a market structure that previously launched one of the most powerful rallies in Bitcoin's history. Now, for the critical part, comparing the 2020 setup side by side with today, it's not enough for them to just look similar. We have to break down the similarities and, just as important, the differences. This is how we separate hype from actual analysis. The striking similarities. Let's start with what makes this setup feel like déjà vu. The chart pattern. The core similarity is the price action itself. In both 2020 and 2025, a major market event led to a period of uncertainty and range-bound trading. This consolidation does the same job in both cycles. It absorbs the shock and builds energy for the next big move. The shape, a violent drop followed by a tight coiling of energy, is remarkably alike. Moving average dynamics. The behavior of the 50-day and 100-day SMAs is another key parallel. In 2020, they flattened and converged. Today, we're at that same inflection point. The price is trading below both, and they're squeezing together. A powerful move back above them, causing the 50-day to hook upwards, would be a textbook repeat of the 2020 signal. On-chain parallels, MVRV, and Puel multiple. The on-chain data is even more compelling. The MVRV Z-score in 2020 reset to a neutral floor before the next big climb. We're seeing the exact same thing today. The froth from the $126,000 high has been wiped out, and the MVRV is now in the same mid-range territory that preceded the 2020 surge. We can even add another layer, the Puel multiple. This tracks miner profitability. Back in 2020, this indicator was in a neutral zone before the breakout. Today, after the flash crash, the Puel multiple has also taken a big dip. This reset is a necessary step for a sustainable uptrend, perfectly mirroring where things were just before the Q4 2020 explosion. The critical differences, the counter argument now for the reality check. History rarely repeats perfectly, and ignoring what's different would be a mistake. The elephant in the room, spot Bitcoin ETFs. This is the single biggest difference between then and now. The launch of US spot Bitcoin ETFs in January 2024 fundamentally changed the market. In 2020, Bitcoin was still mostly a crypto native game. Today, it's a mainstream asset available in millions of brokerage accounts through giants like BlackRock and Invesco. This is a double-edged sword. On one hand, ETF inflows create a huge source of demand that didn't exist in 2020, which could make any breakout even more powerful. On the other hand, it ties Bitcoin more closely to the stock market and global risk sentiment. The ETFs are a potential rocket booster, but also a new way for traditional market shocks to hit crypto. Market maturity. The Bitcoin market of 2025 is far more mature than it was in 2020. The derivatives market is bigger and the players are different. The 2020 rally was famous for its retail-driven narrative. In 2025, the market is heavily influenced by giant asset managers, hedge funds, and corporate treasuries. This could mean moves are more measured. Or, as we saw on October 10th, it could mean that when leveraged institutions unwind, the crashes are even more severe. Macroeconomic environment. The macro backdrop is also completely different. In late 2020, central banks were printing money like crazy in response to the pandemic, creating a massive tailwind for assets like Bitcoin. Today, in October 2025, things are more complicated. The Federal Reserve has started cutting rates, but we're coming out of a period of aggressive rate hikes. The economic tailwind just isn't as strong as it was in 2020. So, while the technical and on-chain signals are rhyming almost perfectly with the 2020 launchpad, the market itself has grown up. The ETFs, the institutional players, and the tricky macro picture are the wild cards that could change the outcome. So, here's the main idea. Because the technical and on-chain structure looks so much like the Q4 2020 setup, a repeat performance is highly probable if certain levels are hit. But a thesis isn't a guarantee. We need to define the exact price levels that will either prove or disprove this pattern. This is how we create a real strategy using if-then scenarios. The bullish scenario, pattern validation for history to repeat, and for us to get that 60% surge, here's what needs to happen in order. The breakout confirmation. First, we need a decisive break and hold above the current resistance at $112,000. We're looking for a strong daily candle to close above this level, ideally on good volume. This would tell us the bulls are back in control. Reclaiming the moving averages, a breakout above $112,000 would push the price back over the 50-day and 100-day moving averages. The real confirmation would be seeing the 50-day SMA hook upwards and accelerate away from the 100-day SMA. That would be the sign that this isn't a fake out. If those two conditions are met, the pattern is active. A 60% surge from the breakout point, let's use $110,000 as our base, gives us a primary price target of $176,000. Along the way, we'd watch these levels. First target, the old high. The first big test would be the previous all-time high around $126,000. Intermediate target, after that, the $150,000 psychological milestone would be the next area of resistance. Primary target, the full measured move brings us to the $175,000 $180,000 region. The bearish scenario, pattern invalidation. Good analysis means knowing where you're wrong. If the price goes the other way, this is the line in the sand. The support breakdown. The whole bullish idea rests on this consolidation range holding as a floor. So, a decisive break below that floor would kill the pattern. The critical support level to watch is the crash low around $104,000, $105,000. A daily candle closing firmly below $104,000 would mean sellers have won this fight. The death cross confirmation, a price breakdown would be confirmed by the 50-day SMA crossing below the 100-day SMA, a true death cross. This would signal a new bearish trend. If that happens, the price targets flip to the downside. First downside target. The first major support would be the huge psychological level of $100,000. Second downside target. If $100,000 fails, the next support zone is around $92,000. Worst case scenario, in a full bearish reversal, a drop towards the $80,000, $85,000 zone would be in play. By setting these levels now, we can watch the chart without emotion. We're looking for either a break above $112,000 to confirm the bull case, or a break below $104,000 to invalidate it. The market will tell us what it wants to do. So, what's your take? We've looked at the history, analyzed the similarities and differences, and defined the key levels. The evidence for a repeat of the 2020 launch is definitely there. But the counter arguments, especially the ETFs and the macro climate, are real. They're the variables that make this so interesting. Is this the final consolidation before the next explosive move up? Or is the market going to roll over and give us a much deeper correction? This is a huge moment for Bitcoin, and how this pattern resolves will likely set the tone for months to come. I want to hear from you. Let me know in the comments. Are you bullish, thinking history is about to rhyme? Or are you cautious, thinking this time is different? What other factors are you watching? Drop your analysis and price targets below. And if you got value from this breakdown, make sure to like this video and subscribe to the channel. Hit the notification bell so you don't miss our updates as this plays out. Bitcoin is at a major crossroads. A rare historical pattern that last appeared in late 2020, just before a massive 60% plus price surge, is forming again. This pattern is defined by a tight consolidation after a crash, a squeeze in the key moving averages, and a reset in on-chain health metrics like the MVRV ratio. We saw how this exact setup kicked off the epic 2021 bull run. We've also seen how today's chart and on-chain data are mirroring that precedent with striking similarity. But we also have to respect what's different. The game has changed with the introduction of spot Bitcoin ETFs, a more institutional market, and a shakier economic backdrop. These are powerful wildcards that could change the outcome. This all boils down to two clear, actionable scenarios. The bullish case ignites with a decisive breakout above $112,000, which opens the door for a potential run to $176,000. The bearish case takes over if support at $104,000 breaks, shifting the focus to downside targets starting at $100,000. The board is set, the pieces are moving. Whether we get a historic repeat or a sharp deviation will be decided by which of these levels breaks first. This is a time for vigilance. Watch the levels, respect the price action, and be ready for what's coming. The next big move is on its way.